within the dominance of U.S. finance, there's got to be a risk out there. We were talking earlier about hedge funds and the challenge of the new epsilon out the right side of the equation. What is the risk you see if it's not leverage?
I don't see systemic risk these days.
Then why are hedge funds so underperforming?
Well, hedge funds have been underperforming, I think, because in a zero-rate world, it's not intuitively obvious how to allocate capital. And hedge funds allocate capital. And so in a world where rates are significantly higher, I think it's going to be easier for both active managers and long-short managers to outperform.
This is a critical statement from Mr. Eisman. And then when the Fed gets into action and we get an actual nominal rate rising and critically the inflation-adjusted real rate rising, that's a quadratic impulse. The first rate increase, the second rate increase has an effect. The fourth, the fifth, the eighth increase has a huge effect. Where is the timeline where you think that really slams in, where the oomph of that, the inertial force of those rate increases really affect investment?
Well, I think it's infecting it now. I mean, you're seeing a lot more dispersion. You're seeing a lot more volatility. People are starting to wax poetic about when's the next correction. It's happening now. I think that's why I think active management is going to do better.
What are you doing in the first quarter? What are you learning in the first quarter for your investments at Neuberger Berman that you're going to use for the rest of the year? What's the Eisman strategy that's adapted and adjusted given the tumult of the last 6 weeks?
I think that with higher rates, investors have less forgiveness for mistakes. And so, there are more things to go long and there are more things to go short. And you can really construct a portfolio that produces alpha more easily than in the past several years.
Mm-hmm.